Good evening, everyone. So I'm just going to make a quick video on the new gap finder that was developed by our developer, Reverse. So this is a chart of Roku. Roku is just one of our top strategies. There's a lot of strategies, strategies for Apple, strategies for Google, but Roku is just one in particular that has pretty good risk and reward and a good batting average. And this indicator that comes with the toss option algorithm will enable you to identify pre-market gaps or gaps in general. And we identify a lot of the pre-market gaps as our targets, potential targets. So this is Roku on a 10-minute time frame. And I just want to go ahead and just add the customizable gap here. And it's identified in these white shaded regions, plus anything that's white indicates a gap. So here's Roku on the 10-minute, and it shows like a huge gap at around from 400 to 420, and then another one at 344, and one here at 323 down to 286. Now, after Roku's pulled back from its high here, from 492 all the way down to here, that's 41% pullback. Oh, well, not 41. Sorry about that. It's a little bit less than that, right? So maybe as low as this, about 36%. Okay. So after a 36% pullback, you can see that you have the playing field kind of defined for you in these white shaded regions. So then you can make an assumption that after dropping 36%, why not drop down and fill the gap down to 284, right? And that's possible. And then there's if you don't think that's possible, then there's a gap here at 342, and then possible gap here at 420. Now we have a strategy that is associated with the timing part of this going into Thursday, Friday, Monday, and Tuesday called TGIT. And these are the targets that we'll be looking to manage our positions in. It's a long only strategy. On the right hand side, this is same thing, Roku, but I'm going to turn the extended hours on and then introduce the customizable gap. And when we have that there, we can see that there's a lot more zones or pre-market gaps, and I think there's probably some limitation on the number of gaps it identifies with. We don't need to know them all, but let me see if I can change it to a 7-8 minute. Yeah, they kind of disappear, or they probably can't find any gaps because on a higher time frame those gaps look like they've been filled, right? So you've got to strike a nice balance between the larger time frames in conjunction with the lower time frames. Let's see if we can find any gaps in the past here. Yeah, and if the gaps are not being identified, it means they've been filled. Or I think there might be a limitation. But in the short term, this is the time frame that we have for using 10 minutes. And then you can see all the pre-market gaps that are currently open. And there's a target here at 329, and then which corresponds to these two long wicks. That was from September 14th and 13th, and they're all kind of the tops of each of these where the price got rejected. So when we plot them in side by side, you can see that there's a lot more managing when we introduce the pre-market extended hours compared to the non-extended hours. So you might think about when you look at the playing field on the left-hand side with the extended hours, regular hours on, So that's extended hours off. You can see that the playing field is a lot more simple. Okay, and I don't know if that's a safe assumption to make, because when you turn on the extended hours, you can see that there's a lot more complicated or zones where there could be resistance that you can't really see on a regular time frame. So that's one of the nice features. So then we go ahead and then maybe turn on the daily time frame. See, so when you're in a daily time frame, you can see all the gaps that are left open, and your playing field becomes a lot bigger, and your assumptions become a lot bigger, and your probability of success of picking the right direction will probably become a lot lower, right? Because it doesn't go up in a straight line. It'll go all over the place, right? Now, so if this is the case, then it's probably wise to plot your identify all the gaps, right? You're pretty much the job of a trader probably feels like it's looking for gaps and identifying the setups, and then have them displayed there for you so that when the market opens, you're aware of them, right? And you don't get surprised, because if you don't know where they are, then and you're just looking strictly on a higher time frame, the daily time frame, for instance, then your assumptions are just like, okay, well, I think it's bullish, and I don't think this gap is ever going to get filled, and it's going to go straight up here. But maybe it goes up and then goes down. Maybe it goes down and up, right? And we don't know that. And how would we know? Well, in theory, you don't know. All you can rely on is some back testing and maybe switching identifying the centroid of the candle, seeing if it's in a potential if there's a bias in the buying of a particular day. Here the bias is obviously to the downside. Here it's consolidating and more selling bias. And really, if you want to find out how to get an edge into knowing if the price is going to move in the direction you think it's going to go, and you got to do some back testing. So if you look at the back testing here in these days, those are probably some times where you can see some patterns in the buying and the selling. Intraday wise, when you look in a long-term time frame, then your time horizon is measured in days, weeks, and months. But when you're swinging, it shouldn't be any longer than about 4 to 5 days. And then during those 5 days, 3 to 4 days, 5 days, you can get obviously price action to behave the way that it wants to behave. And nobody knows how it's going to be trading in each and every day. So it's all about managing risk when you reach certain points in time where price fills these pre-market gaps with respect to time.